This recording is for the homework for chapters 2 and 3 in the cost accounting book. Unfortunately, we can't have live class due to this snowstorm in October, so I'm going to post the answers, go over them, and post them on YouTube. The first homework problem that we had was exercise 2-18. We're deciding Consumer Focus is a marketing research firm that organizes focus groups for consumer product companies. Each focus group has 8 individuals who are paid $50 per session to provide comments on new products. The focus groups meet in hotels and are led by a trained independent marketing specialist hired by Consumer Focus. Each specialist is paid a fixed retainer to conduct a minimum of number of sessions and a per session fee of $2,000. A Consumer Focus staff member attends each session to ensure that the logistics aspects run smoothly. We're going to decide how to classify cost items A through H. First thing we're going to decide is whether it's a direct or indirect cost with respect to the individual focus group, and then a variable or fixed cost with respect to how the total cost of Consumer Focuses changes as the number of focus groups conducted changes. If in doubt, select on the basis of whether the total cost will change substantially if there's a large change in the number of focus groups. So we'll have 2 answers, direct or indirect, fixed or variable. This is similar to the project that we did in class live. A. Payment to individuals in the focus group to provide comments on new products. That is a direct cost, and it is a variable cost, because it'll depend on the number of focus groups that we have, and it will change. Annual subscription of Consumer Focus to Consumer Reports magazine. That's an indirect cost, and it is a fixed cost. It won't change with the number of groups that we have. Phone calls made by staff. By Consumer Focus staff members to confirm individuals who will attend the focus group. This is an indirect cost. It's just not likely that we'll track this, but it is variable. It will change with the number of focus groups that we anticipate having. Retainer paid to focus group leader to conduct 20 focus groups per year on new medical products. This is an indirect cost, and it is fixed. The retainer is a fixed amount. Meals provided to participants of each focus group. This is direct cost of the Consumer Focus group, and it is variable. Lease payments by Consumer Focus office corporate office. This is indirect, and it is fixed. Cost of tapes to record comments made by individuals in the focus group. These tapes are sent to the companies whose products are being tested. This is a direct cost, and it is variable. Gasoline costs of Consumer Focus staff for company-owned vehicles. Staff members submit monthly bills with no mileage breakdowns. This is indirect, but it does vary with the number of Consumer Focus groups we have. The next problem we have is 2-28. Each of the following costs pertains to one of these companies: General Electric, which is a manufacturing sector company; Safeway, a merchandising sector company; and Google, a service sector company. We're going to decide what type of cost this is. We need to distinguish between manufacturing, merchandising, or service sector, and distinguish between inventoriable costs and period costs. First thing we have, Pierre Mineral Water purchased by Safeway for sale to its consumers. Safeway is a grocery store. So, that is a merchandising cost, and it is inventoriable. It's an inventory cost. B. Electricity used to provide lighting for assembly line workers at General Electric's refrigerator assembly plant. This is a manufacturing cost, and it does go into the inventory cost of the refrigerator. C. Depreciation on Google's equipment used to update directories of website. This is a service sector cost, and it is a period cost. Electricity used to provide lighting for Safeway store aisles. This is merchandising, and it is a period cost. Depreciation on GE's computer equipment used for quality testing on refrigerator components. This is a manufacturing cost, and it is part of the inventory cost, so it's inventoriable. Salaries of Safeway's marketing personnel planning a local newspaper ad campaign. This is a merchandising cost, and it is a period cost. Pierre Mineral Water purchased for Google for consumption by its software engineers. Notice that the mineral water is two different types of cost depending on the company using it and what type of company they are and what they're using it for. So this is a service company, Google, and it is a period cost. It's not part of their inventory. Google doesn't have any inventory as a service company. Salaries of Google's marketing personnel selling banner advertisement. This is a service cost, and it is also a period cost. Now that we're done with Chapter 2, we're going to move on to Chapter 3. So Chapter 3, we're going to do 3-17 and 3-19. 3-17. Garrett Manufacturing sold 410,000 units of product for $68 per unit in 2011. Variable cost per unit is $60, and total fixed cost is $1,640,000. We need to A, calculate the contribution margin, and B, operating income. We then need to Garrett's current manufacturing process is labor intensive. So Kate, Garrett's product manager, has proposed investing in state-of-the-art manufacturing equipment that will increase the annual fixed cost to $5,330,000. The variable costs are expected to decrease to $54 per unit. Garrett expects to maintain the same sales volume and selling price next year. How would acceptance of the proposal affect your answers to A and B? And should Garrett accept the proposal? Explain why. So the first thing I'm going to do to solve this problem is I'm going to make a little list to myself of what we already know. So we know that the selling price of the unit is $68 per unit. We know that the variable cost per unit is $60. We know that the number of units sold was 410,000. And we know that the total fixed costs are $1,640,000. So the first thing I want to do is step 1, I need to find the contribution margin and operating income based on this information. So I'm going to take the selling price. So I'm going to find the contribution margin. I'm going to find the sales revenue. And the way we do that is I take equals the selling price per unit times the number of units sold. So we have sales revenue of $27,880,000. Then I'm going to take the cost of goods sold. And I find that by taking the variable costs times the number of units sold, which is 410,000. And we can just call this variable costs. So, to get to my contribution margin, I will take the 27 million sales minus the variable costs. Based on this information, I have a contribution margin of $3,280,000. Next, I'm going to find the operating income. I'm going to take the contribution margin from above, and I'm going to take the fixed costs, which we listed as $1,640,000. To find my operating income, I'm going to subtract the fixed cost from my contribution margin. So I'm going to take this, subtract my fixed cost. So I have an operating income of $1,640,000. The second question asks if we decided to change the fixed cost to $5,330,000 and decrease our variable cost by $54 per unit, what's going to happen? So I'm going to fill in my given information. Part 2. So our selling price remains the same, $68. Our variable cost per unit changes to $54. Our number of units sold doesn't change, which was 410,000. And our fixed costs increased to 5,330,000. To solve the problem, what that's going to do to my contribution margin and operating income, I'm now going to go forward and solve the same problem I did above. So my sales revenue equals my selling price times my number of units sold. Sales revenue didn't change, but variable cost did, because our variable cost per unit changed. So it's going to be the variable cost per unit times the number of units sold. So now my new contribution margin is equals the 27 million. So our contribution margin went from 3,280,000 to 5,740,000. Well, let's see what happens with operating income. CM for my contribution margin, which I'm going to take from above, fixed costs. So my new operating income $410,000. So instead of having $1,640,000, my old operating income, new operating income, if I purchase this new equipment, we should actually do this the other way around. My new minus my old operating income, which means we have a loss of $1,230,000. Question was, should we do this? Insert a little text box here. This decision would decrease operating income by $1,230,000. My thought on this would be that management would consider other factors before making the final decision. It is likely quality would improve as a result of using the state-of-the-art equipment due to the increased automation. Probably many workers would have to be laid off. Garrett's management will have to consider how this action will affect employee morale, in addition to the proposal of increased fixed costs dramatically. This would increase the company's operating leverage and risk. So there would have to be other information before I was able to make this decision whether or not we would go forward with this. So what I'm going to do is move on to 3-19, and I'll post the answer to that in the Excel file. Alright, moving on to 3-19. The Super Donut owns and operates 6 donut outlets in and around Kansas City. You are given the following corporate budget data for next year. Revenue, $10 million. Fixed cost, $1.8 million. Variable cost, $8 million. Variable costs change with respect to the number of donuts sold. Compute the budgeted operating income for each of the following deviations from the original budget data. First, we're going to have to compute the original budget data. So, revenues. We're going to put what we know. I always like to start out and make lists of what we know, and that helps me go forward and solve the problem. Well, we know revenues are $10 million. Variable costs is $8 million. So we knew our contribution margin currently equals $2 million. Our CM, contribution margin, equals $2 million. And our fixed costs equals $1,800,000. So our operating income currently equals $200,000. This information and how to solve these problems will help going forward into chapter 6, which is the next chapter that we'll do, which was $2 million. I'm going to times that by 1.1, which will give me, in fact, a 10% increase in the contribution margin. I'm then going to subtract my fixed costs, which are $1.8 million, to get my new operating income. So my new operating income, if I have a 10% increase in contribution margins, is $400,000. Problem number 2. A 10% decrease in contribution margin, holding revenues constant. So I'm going to take my contribution margin from the original problem, which was my $2 million. I'm then going to times that by 0.9, which will give me my 10% decrease. I'm also going to format this cell to a currency. It's driving me crazy that there's random decimal points. So I take my contribution margin, my fixed costs remain the same, which is my $1,800,000. My new operating income equals 0. So I'm just going to highlight my answers here in yellow. Number 3, a 5% increase in fixed costs. Let's see what this deviation will do to our budget. So I have my contribution margin, which was originally $2 million. I then have fixed costs, and I'm going to take that 1.8 million times that by 1.05, which will give us a 5% increase in fixed costs. And my new operating income equals $110,000. Before it says a 5% decrease. In fixed costs. So I know my contribution margin is the same as above. I know that my fixed costs were originally $2 million. I'm going to times that by 0.95. That will give us a 5% decrease. So my new operating income will equal So I took my fixed costs, multiplied that by 0.95, and that gives me a new operating income of $290,000. Moving right along with our budget deviations. An 8% increase in units sold. So the first thing I'm going to do is do my revenues. We're going to have an increase in this. So my original revenues were $10 million. I'm going to multiply that by 1.08. Well, my old variable costs were $8 million. I'm going to times that by 1.08. So my new contribution margin equals then to figure out my operating income, I need to take my contribution margin calculated above, find my fixed costs, which were 1.8 in the beginning, and subtract this. So an 8% increase in the number of units sold would change my operating income to $360,000. Number 6. An 8% decrease in units sold. So my revenues, instead of increasing, we'll take this $10 million and times it by 0.92. I will then take my variable costs and times that by 0.92. So my new contribution margin, if I had an 8% decrease in units sold, would be $1,840,000. My fixed costs My fixed cost is 1.8 million. And therefore, my operating income would then equal $40,000. Number 7, a 10% increase in fixed costs and 10% increase in units sold. Let's see what happens here. We're going to have a 10% increase. So I'm going to multiply this by 1.10. And then variable, we're going to have a 10% increase in that. My contribution margin, so my contribution margin is now $2,200,000, and my fixed cost increase times 1.1. So my operating income equals $2,200,000. I'm sorry, 220,000. I think I'm seeing too many twos in here. And last but not least, we will have a 5% increase in fixed costs and 5% decrease in variable costs. So, we don't do anything to revenues, stays the same. My variable costs used to equal $8 million, but we're going to assume a 5% decrease. So I'm going to times that by 0.95. So my new contribution margin now my contribution margin is $2,400,000. My fixed costs have a 5% increase. So equals my 1.8 times 1.05. So my new operating income equals $510,000. Figuring out our new operating income and changes in budget variances, we'll go over next time. So this is an overview of Chapter 3, which we will then use in Chapter 6, 7, and 8.